Welcome to ArthaX Finance, your trusted partner in simplifying global finances. Many people are confused about taxation for equity and equity mutual funds. I'll make it simple for you. In this video, let's go through long-term capital gains tax. First, let's understand the criteria for long-term capital gains and its tax implications. If you sell your shares or equity mutual funds after 1 year from your purchase date, that's long-term capital gains. And then you pay 12.5% tax on gains above rupees 1.25 lakh and then additional 4% cess. We'll understand this with a simple example. Let's say you invested 10 lakh rupees in TVS Motors in 2023. And today the value is 16 lakhs and you sold that shares. Thus you made long-term gains of 6 lakhs. Now you pay 12.5% tax on gains above 1.25 lakh. Thus you pay tax only on 4.75 lakhs, which is 59,375 rupees and additional 4% cess, which is 2,375 rupees. But you can still save rupees 59,375 tax. That's the critical point which many people miss. You can use Basic Exemption Limit to reduce your long-term capital gains tax. Now, the Basic Exemption Limit depends on individual's age. Look at this table below. Any person who is less than 60 years of age under the old regime, the Basic Exemption Limit is 2.5 lakhs. However, any person who is a senior citizen, that is, he is more than 60 years but less than 80 years, the exemption increases to 3 lakhs, and anybody who is 80 years or more, it goes up to 5 lakhs. However, under the new regime, irrespective of age, the basic exemption limit is the same, which is 3 lakh rupees. But one important point to note over here, this basic exemption limit to offset the LTCG tax applies only to residents and not to the NRIs. Now we have all the details. Let's understand with two examples to make it crystal clear. We call the person as Arnav, an Indian resident 65 years old. He has no other sources of income. He invested 25 lakh rupees in equity mutual funds in January 2024 and the value was 30 lakhs in February 2026. Now we have to calculate his gains and how much tax he has to pay. First, we have to calculate his holding period. In this case, it is 2 years. Thus, Arnav qualifies for LTCG tax. Now let's calculate the tax portion. So the total gain from this investment is 5 lakh rupees. The exemption that he can get from LTCG is 1.25 lakhs. After that, he can still use the basic exemption limit, which is 3 lakhs. Remember, he is a resident and a senior citizen. So the total taxable LTCG comes to 75,000 rupees. Now he pays 12.5% long-term capital gains plus 4% cess. So the total tax payable which Arnav has to do is 9,750 rupees. Now take another example. What if Arnav was a non-resident? How will his tax liability change? We'll keep the same details. Now look at the table. Again, the long-term capital gain will be the 5 lakhs. He can still use that LTCG exemption, which is 1.25 lakhs. But now he has to pay tax on 3,75,000 rupees. Because being a non-resident, he cannot use the basic exemption limit to reduce his long-term capital gain tax. So in this case, he ends up paying tax of 48,750 rupees. Now you have clearly understood how does taxes work on long-term capital gains for equity and equity-oriented mutual funds. But it is best understood when you do the practice on your own. I will give you an homework which you can do and it will help you a lot. Assume there is a person called Krishna who is 70 years old, a retired army officer with below sources of income. So his pension from army is 2 lakhs per annum, and in the financial year he had a long-term capital gains from mid-cap funds which was 2 lakh rupees. Now you have to calculate his long-term capital gain tax. Drop your answer in the comments. In the next video, we'll discuss about short-term capital gains and its taxation implications on equity and equity-oriented mutual funds. Thank you so much.